Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for the segment, we have Russell Rhoads, Associate Clinical Professor of Finance at Indiana University, and Dan Deming, Managing Partner at KKM Financial. They join me to discuss how options traders use straddles when they're not sure which direction the market may go. Russell, it's great to see you as always. Let's kick it off with you. You recently published a paper on Nasdaq's website about selling short-dated NDX straddles. What is the key takeaway, and do you have any updates for April?
Oh, absolutely. I updated April over the weekend, but I'll start off with the key takeaways on that paper. Basically, what we did was we looked at the at-the-money straddle on the close 1, 2, 3, 4, and 5 days before expiration. Priced those using the midpoint, add a little slippage to try to make a little bit more real world, and then took a look at does consistently selling those straddles make money? Does consistently buying those straddles make money? It's very possible with slippage that both sides could lose money, which if the market were perfectly efficient, that's what would happen. And what's really interesting about our findings was that you really can't make money in the 1 day straddle, both buying and selling, when the trading costs get in there. A lot of people are focused on the very short term. We hear zero DTE ad nauseum, whether you're watching a webcast about options or going to an options conference, it's all about zero DTE. I know that was a big topic at the OIC as well. But there are 5 consecutive days of NDX options available for trading. And if you, instead of looking at the first and second day, take a look at the third, fourth, and fifth day. And on a very consistent basis, if you were to sell an at-the-money NDX straddle that expires in 3, 4, or 5 days, and we prefer the 3-day, not necessarily because it's more profitable, but the drawdowns aren't as dramatic, but consistently selling a 3-day at-the-money straddle has been quite a profitable approach. And in the paper, it was the last 15 months. Now it's the last 16 months, because in April, you would have taken about 700 points out of the market just selling an at-the-money NDX straddle that expired in 3 days and consistently having that position on. As I just mentioned, updated the numbers for April, and the numbers for April, 2, 3, 4, and 5 day straddles on the short side made money. Long and short 1 day straddles, both of those actually lost money equal to about the trading costs.
Dan, and this is something that you've used trading S&P 500 options as well.
Yeah, absolutely, Jill. You're seeing a lot of activity, and at-the-money straddle is certainly the focus when you look at the volatility space, and particularly how it impacts the price action in various derivatives off of the price action of the at-the-money straddle. And let's say for the SPX in this case, where you're looking 30 days out, implied vol levels. And again, trying to understand and discern between how the VIX is being priced based on a chain of options and where the at-the-money straddle is. And one thing that I could tell you just from a price action standpoint, Jill, here in the last few weeks, as Russell has pointed out, something that's a little bit more of a strategy over longer term, but just looking at the recent price action in the SPX, we have seen that at-the-money straddle go from a 16 implied vol 2 weeks ago down to 12 in the last 2 weeks. And again, has a lot to do with the price action within the SPX, but also has a lot to do with the Greeks involved as well. And I think you're seeing compression of the at-the-money straddle because the market has found some stability. That recent volatility has come out of the market, and the speed. I think the one thing that really caught us a little bit, caught our eye, is the speed of the decline in the implied vol once the market found some stability.
Russell, let's take a step back here for a moment. Why would traders use this type of strategy that you described in your article? Is there a way to make money off of it, or is it more of a way to learn more about what's happening within the market and being able to identify those trends within the volatility complex?
It definitely is a way to go about making money over a long period of time. I'll backtrack a little bit and use a Wall Street saying. They say, pros sell options and retail buys options. And the idea behind that is that over a long period of time, option sellers are gonna, keep hitting singles over and over again, might get run over periodically, which I can show you. Selling a 1 day straddle doesn't work particularly well. Selling the 3 day straddle works particularly well, but over the last 16 months, there are 3 months where you would have lost over 1,000 points. Right. So the drawdown is pretty dramatic. But looking at it from that standpoint is something that I think individuals should be doing. But also, and Dan brought this point up with SPX, we've been using volatility indexes forever to get an idea as to what the mind of the market is. Well, you can take a look at the at-the-money straddle for 1 day out or 1 week out, et cetera, and that can give you an idea as to what the market's thinking for near-term volatility. So I've tracked the pricing of the 1 day at the money straddle, and right in line with what Dan was saying, the average 1 day at the money straddle in the NDX complex was priced at just over 1.1% of the underlying last year. It's averaging under 0.8% this year. Yeah. So we have seen a reduction in the pricing of the at-the-money straddles, even though 1 day at-the-money straddles don't necessarily make money being a seller in that space. But one of the things that I want to do, kind of one of the next steps that I want to do with this data, is use what the 1 day straddle is predicting and maybe use those numbers to choose the strikes for an iron condor, et cetera. Okay. So I've used 30-day volatility indices. My assumption is 1 day straddle data is going to help, or it's going to be a lot more accurate with respect to the strikes that you might want to choose.
Dan, do you think with all this new product that's been introduced with the zero dated options, has that influenced the options market at all, whether it's intraday or the way that regular wave expiration cycles work? Is there any influence because of all this product that's out there?
It certainly appears to be the case, Jill. I think as the studies continue to roll out, and I'm sure Russell will continue to dig into this and figure out those nuances, but it does appear, just from my experience, that there is a significant impact as far as just the pricing structure. And again, I guess the one thing that I think that we believe, as far as looking into this, is the efficiencies of the markets continue to evolve. I've watched this evolution really since I started on the floor back in the late 80s. The efficiencies of the markets continue to get refined, and now with the activity being shorter dated, and the volumes just really surging now, that the markets appear to be, again, a prime example is the speed of where, seeing the at-the-money straddle, even just looking 30 days out, but that's having an impact on the options chains and all the different durations as well. That how efficient the market is pricing in, let's say, realized volatility. And I think Russell brings up a great point, looking at the NDX. Last year, you had a little bit more realized volatility in the market. And again, that accounts for the reason why you're looking at a little bit higher price structure. Now you're not seeing that realized volatility. I mean, we're looking at really 30-day realized volatility, which basically is a measure of the last 30 days of the price movement in the SPX. At very low historical levels. So again, if you're not getting those intraday moves, options traders are very quick to kind of pull in their bids and not be willing to pay up for options because of the theta and the decay factor.
Mm-hmm. Oh, Russell, let me ask this a different way then. It sounds like the more product that we see out there with the zero dated options expiration, is it better for the market since it's more efficient?
Oh, I always believe any way that you can manage risk that gives you an approach that you haven't been able to use before is good for the market. I mean, even when I was employed at SIBO, I wanted to see other volatility markets thrive, because I feel like the more participants, the more instruments, the more liquid the overall complex is. And the short dated index option trading, I would equate that to all the day trading that occurs in the S&P 500 futures. It's the same sort of liquidity pool that you can dip into when you're trying to execute a trade. As far as the impact on longer dated options, you've got to assume that quantitatively, I did some digging, and it appeared to me that VIX was not really impacted by the introduction of daily options, because V stocks behaved the exact same way as VIX in 2022 and 2023. And they didn't have daily options in Europe until late 2023. But on the other side of that, when I was at the Options Institute, we would always talk about why does VIX spike up when market participants are worried about, or when the market's starting to sell off? And it's because of this short-term worry that comes into place. You only had a few strikes to choose among when you were thinking about, putting on a quick hedge because you're worried that this is the beginning of, 10, 20% drawdown. Those 10 to 20% drawdowns, the ones that they tend to be very dramatic and happen in less than a month. So, if I were back on the buy side and I was worried about a near-term sell-off, I wouldn't be looking out 30 days. I might look out a couple of weeks. Also, you want cheaper protection, and it's just a function of an option only having a couple of weeks versus a month to expiration. Those options are going to be cheaper as well.
Yeah, it's kind of like not buying insurance when your house is already on fire, right, Dan?
Exactly.
Yeah, exactly. Yeah, there's different metrics involved, but again, I think Russell brings up a great point. I think I think the mindset behind what's taking place in Bitcoin as well is that when you see what is in theory you want to there's debate about is a volatility an asset class or not. I mean, we can debate that, but nonetheless, the idea is that as you see an evolution of interest into a part of the market. Like we did see in the VIX coming in, like 06 when the options were listed. I think it was the futures were 04, but just the evolution. And again, think about that. I mean, basically, you're looking at a market that's only about, from an option standpoint, only about 18 years old, which, it's still maturing to some degree. And as Russell pointed out as well, it's being incorporated into more and more different parts of the market because of the interest, and then you got the liquidity, and then the liquidity brings in more market participants, and then the markets become more efficient because, again, that's just the natural evolution, that I've experienced multiple times in my trading career over the years. So that's, I think, ultimately a very strong reinforcement that the volatility space is an asset class.
All right. Appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.